Most traders lose money, not because they can't read a chart, but because they can't read themselves. Trading isn't a game of numbers, it's a mirror. It shows you who you really are. Now, if you want to double your win rate, not by luck, not by guessing, but by method, then pay attention. Because today we're going to talk about the 3 steps that can turn your trading results around almost overnight. And if you remember the previous video on how to read early market signals, this will feel like the missing piece you've been waiting for. Now let me tell you something, my friend. The market doesn't care who you are, how smart you think you are, or what kind of fancy setup you've got on your screen. The market is a judge, and the only verdict it gives is whether you've followed the truth of price. You ever notice how some traders always seem to be on the right side of the move? Not all the time, but more often than not. They're not magicians. They're simply disciplined enough to take only the best trades. That's step 1, cut the noise. You see, a trader's greatest enemy isn't the market. It's the temptation to act. The urge to trade every little flicker of movement, every small rumor. I learned that the hard way, back when I was just a boy in the bucket shops. I'd see a stock tick up and think I was missing the move, so I'd jump in, only to watch it reverse and clean me out. The lesson: don't anticipate the market, let the market show its hand first. Do you have the patience to wait for confirmation? Most don't, and that's why most fail. Now, once you've cut the noise, you come to step 2, trade only when the odds are in your favor. That sounds simple, but it's the hardest rule to follow. Every successful trade I ever made came from recognizing when the market had already made its direction known. You don't need to catch the top or the bottom. Those belong to dreamers. What you need is the middle. The fat, safe part of the move, where the trend has already declared itself. You ever notice how the biggest profits come from sitting, not from trading? That's because sitting in the right trade is where the real money is made. I remember watching pools of capital shift in the tape, big money moving quietly before the public even realized what was happening. That's why I always say the tape tells the truth. It whispers before it shouts. And if you studied the early market signals we talked about before, you'll see that this step builds directly on that foundation, recognizing those quiet moves before they become headlines. But let's be honest. Knowing when to act is one thing. Having the nerve to act is another. Which brings me to step 3, trust your own judgment once it's earned. Notice I said, once it's earned. Too many traders think confidence comes from being right. It doesn't. It comes from following your method faithfully, win or lose. The market doesn't owe you a profit. It rewards consistency. When you've built a system that reflects your own understanding of price behavior, you stop being tossed around by opinions and noise. Ask yourself this. How many times have you had a good trade setup, only to talk yourself out of it because someone on social media said the opposite? How often do you second, guess your own plan because you fear being wrong? That's what kills traders, not losses, but hesitation. A trader who can't trust his own judgment is like a captain who doubts his compass in a storm. You must learn to see the market as it is, not as you wish it to be. The market has no interest in your hopes or fears. It doesn't care if you need to make rent this month, or if you've had 3 losing trades in a row. It's cold, it's fair, and it's always right. Once you accept that, your entire approach changes. You stop chasing trades. You stop forcing outcomes. You begin to wait, and waiting, my friend, is where money is made. Let me ask you something. What would happen if, for the next 20 trades, you only took setups that met every rule in your playbook? No exceptions. No emotion, just clear, verified signals. I'll tell you what would happen. Your win rate would rise instantly. Not because the market got easier, but because you stopped getting in your own way. Most traders fail because they think more trades equal more opportunities. But in truth, more trades often mean more mistakes. The great money is made in the big moves, and those don't happen every day. My biggest wins came not from taking more trades, but from taking fewer and holding them longer. That's the paradox of trading. The less you do, the more you make, provided you do it right. When you cut the noise, you clear your mind. When you wait for the odds, you sharpen your edge. When you trust your method, you remove the fear. That's how you double your win rate, not by magic but by mastery. Each of these steps reinforces the other. Discipline breeds patience, patience breeds clarity, and clarity breeds profit. You see, the charts are just the surface. What matters is what's beneath them. The accumulation and distribution, the psychology of crowds, the behavior of capital as it seeks advantage. Once you start reading that, you're no longer just a trader. You're a student of the market's language, and that's where consistency begins. Think back to those early signals we talked about in the last video. Those subtle shifts that hint at a new trend forming. When you combine that awareness with these 3 steps, you stop reacting and start anticipating. You become proactive instead of emotional. You're no longer the chaser of moves, you're the spotter of change. That's how professionals operate. They don't trade more, they trade better. Now, I'll tell you something most traders don't want to hear. Even after you master these 3 steps, the temptation to break them will still follow you. Every time you're up a few trades in a row, you'll feel invincible. Every time you take a loss, you'll feel desperate to make it back. That's the old battle between reason and impulse. And it never ends. But your job is to recognize that battle and refuse to let emotion take the wheel. Because at the end of the day, trading is a test, not of your strategy, but of your character. The market exposes greed, fear, pride, and impatience. Confidence in trading is not something you can buy, read about, or borrow from another man's system. It has to be earned, and earned the hard way, through discipline, through repetition, and through 1,000 small decisions that test your nerve and your honesty. Every trader wants confidence, but few want the process that creates it. You can't fake it. The market knows the difference between confidence and arrogance. One keeps you steady, the other destroys you. When I started trading in the old bucket shops, I thought confidence came from being right. I'd catch a few good moves, double my stake, and start thinking I had the game figured out. Then, just as quickly, the market would teach me humility. I learned that the moment you think you can't be wrong is the moment you're already in trouble. The market has a way of punishing pride faster than any other business. So I learned to shift my focus, not on being right, but on trading right. That's where true confidence begins. Think about it. How many times have you taken a trade just because you were afraid of missing out? Or because someone else made it look easy? And how many times did those trades end up being losers? Each of those moments chips away at your confidence. You start doubting your system, then yourself, until you can't tell if you're trading your plan or your emotions. That's what happens when your actions aren't aligned with your own rules. The only way to restore confidence is to stop breaking your own code. A trader's method is his lifeline. It's not about the indicator or the setup. It's about the process. Every system has losing trades, but a system that's followed consistently creates trust. That trust becomes confidence. But if you change your plan every week, chase every new strategy, or trade by rumor, how can you expect to believe in yourself? You're standing on sand, not rock. Confidence built on randomness collapses the first time a trade goes wrong. You see, confidence in trading doesn't come from results, it comes from discipline. You might lose 3 trades in a row, yet still feel calm, because you know you followed your plan perfectly. That's earned confidence. It doesn't depend on the outcome of one day or one position. It's the quiet assurance that over time, your edge will pay off. The traders who last understand this. They know the market is just a long series of probabilities. They don't need to win every trade to feel certain. They only need to know they played their hand correctly. Ask yourself this: when you take a loss, do you immediately look for a new trade to make it back? Or do you stop, analyze what happened, and stick to your method until the next true signal appears? The answer tells you everything about your level of confidence. The desperate trader rushes, the confident trader waits. Waiting takes strength, the kind that only discipline can build. Every great operator I ever knew had the same habit. They recorded their trades, reviewed them, studied their own behavior, not because they loved paperwork, but because they understood that data builds belief. The more you see your system work over time, the stronger your conviction grows. Confidence isn't a feeling, it's evidence. You earn it by doing the work, by testing, by reviewing, by improving one rule at a time until there's no guesswork left in what you do. There's another side to this too. Confidence doesn't mean stubbornness. You can be wrong and still be confident, because confidence doesn't mean refusing to admit mistakes. It means knowing exactly when to cut them. The market rewards those who protect their capital more than those who chase every opportunity. A confident trader can take a loss and feel no panic. He knows losses are part of the business. The insecure trader, on the other hand, sees every loss as a personal failure. And that's when emotion takes control. You've got to train your mind to see losses as information, not punishment. Every losing trade teaches you something. About your timing, your patience, your method. When you stop taking it personally, you begin to act professionally. And that's where confidence grows. It's not about perfection. It's about consistency. Let me tell you something. The market is full of traders who are skilled but not confident. They know every pattern, every technical indicator, every book rule. Yet they freeze when it's time to pull the trigger. Why? Because knowledge without discipline creates confusion. You can't trust your judgment if you keep feeding it with conflicting ideas. Confidence is clarity. It's the ability to say, this is my setup, this is my signal, this is my risk, and I will live with the outcome. You can only reach that point when you stop jumping from one method to another and commit to mastering one. The funny thing is, the more confident you become, the less you feel the need to prove anything. You trade smaller, smarter, quieter. You stop boasting about your wins or hiding your losses. You treat trading like a business, not a contest. Confidence gives you patience, and patience gives you profits. The cycle feeds itself. But it all starts with discipline. The kind that keeps you from breaking your rules, even when temptation whispers in your ear. You may think it's the big winning trades that make you confident. It isn't. It's the small moments. The times you waited instead of chased. The times you took the loss instead of hoped. The times you followed your system to the letter. Each of those moments adds a brick to the foundation of your confidence. And one day, you'll find that the market can move any way it likes, and you'll remain steady. Because your trust won't be in luck, or in news, or in other traders' opinions. It'll be in yourself, and in the method you've proven through discipline. Confidence built that way can't be shaken. It doesn't come and go with the market's mood. It stays because it's earned, not imagined. And until a trader earns that kind of confidence, every trade will feel like a gamble, every loss like a wound, every win like an accident. But once that confidence is built through disciplined execution, cutting the noise is the first thing every trader must learn if they ever want to see real progress. Most traders lose not because they lack intelligence, but because they drown in too much information. They have so many indicators, alerts, opinions, and news headlines flying at them that they can't hear the only thing that truly matters. The market itself. When you're surrounded by noise, you start reacting to every little flicker on the chart, every rumor on social media, every opinion from someone who sounds confident. That's not trading. That's gambling in disguise. When I started trading in the old days, we didn't have endless data streams or flashy screens. We had the ticker tape, just raw price, ticking away one trade at a time. It forced you to focus. It forced you to think. You learned to recognize the rhythm of the market, to feel the flow of buying and selling. That was the foundation of real trading skill. The more I watched that tape, the more I realized that the market was constantly speaking. But most people were too busy talking to listen. Cutting the noise isn't just about ignoring bad information, it's about learning to listen to the right kind. You ever notice how the best trades often appear quiet? There's no drama, no excitement, no crowd shouting about it. It's just a clean pattern, a clear setup, and a signal that fits your plan. But the noise, the endless noise, makes you doubt it. You start thinking, What if the news changes? What if this analyst is right? What if I'm missing something? Before you know it, you've talked yourself out of the trade. The noise didn't just distract you. It stole your conviction. Most traders think more information means more control. But in markets, the opposite is true. The more opinions you absorb, the less clear your judgment becomes. Every trader should have a filter, a mental gatekeeper, that asks one question before reacting to anything. Does this align with my system? If the answer is no, discard it. It doesn't matter how loud it sounds or how many people believe it. The market rewards clarity, not confusion. I've seen traders with 10 screens and 20 indicators thinking they're increasing their edge, but all they're doing is cluttering their mind. Every indicator tells a slightly different story, and when those stories don't match, you freeze. The truth is, you only need a few reliable tools, maybe price action, volume, and one or two signals you truly understand. Strip it down to the essentials. Once you simplify your charts, you'll be amazed how much easier it becomes to see the truth of the market. Ask yourself this: how much of what you look at every day actually helps you make a decision? Be honest. How many times have you stared at a chart waiting for confirmation that never comes because you're looking at too many conflicting signals? That's the poison of noise. It makes you feel active while accomplishing nothing. A disciplined trader cuts it away like a surgeon. Anything that doesn't contribute directly to better decisions is eliminated. Noise doesn't just come from charts or screens. It comes from people. Friends, chat rooms, headlines, social media. Every voice wants to tell you what the market should do, but none of them will pay for your losses. The crowd will cheer when prices rise and panic when they fall. And if you listen too closely, you'll do the same. That's how most traders get caught buying tops and selling bottoms. The noise of the crowd is seductive because it gives the illusion of safety. You think, everyone's doing it. Maybe they know something I don't. But that's exactly when you should step back. The market punishes comfort. The best trades always feel uncomfortable because you're acting before the crowd, not with it. When you cut the noise, you begin to notice patterns that others miss. You start to see how price reacts to levels, how volume behaves before a breakout, how trends mature before reversing. These are the real clues that lead to consistent profits. But you can't see them if you're buried under a pile of opinions and data. Simplicity creates focus, and focus reveals opportunity. It's the same reason why professional traders often look calm, even during volatility. They aren't calm because they know the future. They're calm because they know what to ignore. They've already filtered the noise before the trading day begins. They're not reacting to every candle. They're waiting for their exact signal to appear. You can only achieve that kind of composure when you've built a rule around what matters and what doesn't. I'll tell you something from experience. The hardest noise to silence is your own. The voice inside your head that says, maybe I should take this trade, just in case. That voice feeds on impatience. The market moves, and suddenly you feel left out, so you convince yourself that any trade is better than no trade. But the truth is, most of your money will come from not trading. The trades you skip because they don't fit your criteria, those are the trades that save your capital, your focus, and your confidence. Discipline is the weapon that cuts through noise. Every time you choose not to act on impulse, you sharpen it. Over time, you begin to notice the market more clearly. You start recognizing what real opportunity looks like. It's quiet, it's measured, and it aligns perfectly with your plan. There's no rush, no panic, no guessing. You just act when the signal is clear and stand aside when it isn't. That's how professionals operate. Noise creates movement, but not progress. It keeps traders busy but not profitable. The goal isn't to be active. The goal is to be selective. Every decision, every chart, every piece of data must earn its place in your process. If it doesn't help you act with confidence and precision, it's noise. Cut it away. You'll find that the less you listen to the market's distractions, the more clearly you can hear what it's really saying. The market has a rhythm, a pulse, a logic that only reveals itself to those who are quiet enough to notice. Most traders miss it because they're too loud in their own minds. They chase opinions instead of patterns, headlines instead of price. But once you cut the noise and focus on the essentials, price, volume, and structure, the chaos begins to fade, and what's left is opportunity, clear as day. Waiting for confirmation before committing capital is one of the hardest lessons a trader can learn, but it separates the disciplined professional from the impulsive speculator. Most traders lose money not because their analysis is wrong, but because their timing is impatient. They see what they think is the beginning of a move. They rush in early, and the market turns against them. They were right about the direction, but wrong about this moment. In trading, the moment is everything. A good idea executed at the wrong time is still a bad trade. You see, the market is a living thing. It doesn't move in straight lines. It breathes, expands, and contracts. Every move has a build-up before it breaks out. That build-up, that tension, is where confirmation comes in. A professional trader waits for the market to prove its intention. Only when price action confirms the setup does he step in with real capital. The amateur jumps in on anticipation. The professional acts on confirmation. That's the difference between gambling and trading with precision. When I was watching the tape in my early days, I learned to see confirmation in the way the ticker moved. You could feel it. The hesitation before a breakout, the pressure building in the price, the volume tightening. The tape doesn't lie. It shows you where real money is stepping in. You can't always predict what's coming, but you can see when it's happening. That's confirmation. When the market tells you, yes, the move has started. The trick is having the patience to wait for that signal instead of guessing when it might arrive. Ask yourself, how many times have you seen a clean setup, jumped in early, and then watched the market stop you out before going exactly where you thought it would? It happens to every trader at some point. That's the price of impatience. You saw the idea, but you didn't wait for the market to validate it. You wanted to be first, instead of being right. The market doesn't reward speed, it rewards accuracy. Confirmation isn't about hesitation. It's about discipline. It's about letting the market reveal its hand. If a breakout is real, it will show strength. Not just a flicker, but sustained movement with volume behind it. If a reversal is genuine, it won't collapse immediately after a single candle. It will build a foundation, test the level, and then move. Your job isn't to predict that. It's to recognize it when it happens. Most traders can't wait because they fear missing out. They see price moving and think, if I don't get in now, I'll miss the whole move. But the truth is, if a move is real, there will always be a second chance to enter. The market gives confirmation to those patient enough to wait for it. You don't need to catch the first few points of a move to make a profit. It's better to come late to a confirmed trend than early to a false one. Waiting for confirmation also protects your capital. Every false breakout, every fake reversal, every deceptive candle is a trap for the impatient. The market is designed to shake out weak hands. That's why confirmation isn't just a technical rule. It's a psychological shield. It keeps you from reacting emotionally. It forces you to slow down, to watch, to listen. You start to trade with the market instead of against it. In the tape reading days, I'd often see stocks that looked ready to move but hadn't quite broken through resistance. I'd wait. Others would jump in early, certain that the breakout was coming. 9 times out of 10, the stock would stall, dip, and take them out. Then, after the weak hands were gone, the real move would begin. That's how the market operates. It punishes those who can't wait for proof. There's a kind of quiet strength in waiting for confirmation. It takes self-control to stand aside while others rush in. It takes faith in your process. You can feel the tension building inside you. That urge to act, that voice saying, just get in now, you'll regret missing it. But trading isn't about excitement, it's about execution. You have to remind yourself that no confirmation means no trade, no matter how good it looks. Think of it this way: confirmation is your insurance. It doesn't eliminate losses, but it filters out bad trades. It's the market's way of saying, no, the odds are in your favor. That's all you can ever ask for, favorable odds. Once you have that, you can commit capital with confidence. Without it, you're just guessing, and guessing has no place in serious trading. You can find confirmation in different ways depending on your style. For some, it's a break of structure on the chart. For others, it's a surge in volume, a retest that holds, or a certain candle pattern that validates the move. The specifics don't matter as much as the principle. Error, wait until the market proves you right before you risk your money. The market speaks through price and volume. When those two align, that's confirmation. The irony is that once you learn to wait for confirmation, your trading slows down, but your results accelerate. You take fewer trades, but better ones. You stop wasting time and energy on setups that never mature. You start thinking like a hunter. Quiet, still patient. You don't chase the prey, you let it come to you. That's how professionals operate. Ask yourself again, what would your results look like if you only entered trades that met every confirmation rule you set? How much frustration would disappear? How much capital would still be in your account? That's the difference patience makes. It's not about finding more opportunities, it's about waiting for the right ones to complete. Most traders think discipline is about cutting losses. That's only half true. Discipline begins before the trade ever happens, in the decision to wait for confirmation. Every time you resist the urge to jump early, you strengthen your control. You train your instincts to align with logic instead of emotion. Over time, your patience becomes automatic. You start to feel uncomfortable trading without confirmation. That's when you know you're becoming a professional. The market rewards those who respect its timing. It doesn't reveal its true direction instantly, it tests conviction first. Those who rush in without confirmation become the liquidity for those who waited. The professionals buy when the amateurs are shaken out. That's how this game works. It's not the fastest who win, it's the most patient. When you finally learn to wait for the market to show its hand before committing capital, you stop fighting against probability and start trading in harmony with it. Trading when the odds align, not when emotion tempts, is one of those principles that sounds simple but defines the entire difference between a winning trader and a losing one. Every trader thinks they make rational decisions, but the truth is, most of them are reacting to emotion, excitement, fear, frustration, or the simple urge to feel in control. The professional doesn't trade because the market moves. He trades because everything lines up. The setup, the signal, the context, and the probability. That's what Ford's alignment really means. It's about stacking the deck in your favor before you commit a single dollar. You see, the market doesn't care how you feel. It doesn't care if you're bored or eager, if you've had 3 losing trades or 5 winners in a row. The market only responds to pressure. Buying and selling, supply and demand. Your emotions have no influence on that. But if you let your emotions guide you, they'll make you act as if they do. You'll start forcing trades that don't meet your rules, taking setups that aren't quite ready, or holding on to losing positions because you feel like they'll turn around. Every one of those actions comes from emotion, not logic, and emotion is the enemy of probability. When the odds align, it means several pieces of evidence come together to tell one story. Price action confirms your direction, volume supports the move, the trend structure agrees, and your entry and stop make sense from a risk standpoint. That's when you have a high probability trade. You don't need to be perfect. You just need to act when the odds are leaning in your favor. A professional trader is like a poker player. He doesn't bet on every hand. He waits for the cards that give him statistical edge. Then he bets aggressively. The rest of the time, he folds. Most traders never learn to fold. They can't stand the silence between trades. I've seen traders lose more money in boredom than in bad analysis. They sit at their desk, waiting for something to happen. And when it doesn't, they make something happen. They convince themselves that a weak setup might still work. That's emotion pretending to be logic. You have to learn to recognize that voice inside you, the one that wants action more than accuracy. Ask yourself, how many times have you entered a trade you knew wasn't quite right, just because you didn't want to miss out? And how often did that trade end up costing you? That's emotion robbing you blind while disguising itself as intuition. The market has no mercy for emotional traders. It feeds on impatience. Every fake breakout, every false reversal, every fake rally. They're all designed to trap those who act on impulse. The crowd always trades emotionally. That's why the crowd always loses. The professional does the opposite. He waits until the evidence stacks in one direction. He doesn't care about excitement, he cares about probability. The more factors that align in his favor, the more he presses his advantage. And if they don't align, he simply waits. He knows that doing nothing is also a decision, a profitable one. Emotion tempts you in subtle ways. Sometimes it disguises itself as confidence, sometimes as hope. You might convince yourself you know the market is about to turn, or that this trade feels right. But the market doesn't reward feelings, it rewards structure. Trading when the odds align means you've checked your boxes. You've measured your risk. You've confirmed your signal.